In today's episode, we are diving into the recent surge of the EV manufacturer Nkla. The rapid rise of this company has left investors wondering about the factors behind it and whether it can be a sustainable move. Also, if you like what I do, please check out the affiliate links down in the description regarding the equipment and the gear that I use. If you make a purchase, it doesn't have to be anything that I recommended, but as long as it's anything on Amazon within the same browsing session, I earn a small commission that may help this channel to grow further. So without further ado, let's start with today's video on NIKOLA. The past few days have been nothing short of astonishing for NIKOLA, to be honest, because in just a few days the shares more than doubled, with a rise of over 60% on Thursday alone. Even in the early trading on Friday, while the S&P and Dow Jones were opening higher, NIKOLA shares were up by another 20%. The stock currently closed at $1.30 on July the 6th and has gained over 100% in just 6 trading sessions. And on Friday, it reached almost $3 before settling at around $2.30, representing another 6.3% increase. The rally that has been triggered is caused by some positive news from NIKOLA. NIKOLA has announced a 50 truck sale to BioTech, a hydrogen producer. Those trucks will be powered by hydrogen fuel cells and used for transporting BioTech's hydrogen gas. While this news started the rally, the significant surge of 114% in less than 2 days also raised a few eyebrows. The short covering may have played a role in fueling the rally, because a lot of short sellers who borrowed stock when they don't own and sell it were potentially caught in a squeeze. When short interest is very high, as it is with NIKOLA, short sellers run the risk of being forced to close their positions simultaneously with positive developments. This rush for the exit and further the drive of the rally. However, the future trajectory of NIKOLA stock remains uncertain. After experiencing a 97% drop from its 2020 all-time high to nearly $94 per share, expectations of reaching those levels again are relatively low. The 52-week high stands at around $9 per share, which some consider as aggressive. The average analyst price is around $2.40 per share, and it's worth noting that Wall Street's previous average price targets were around $10 to $11 just a few years ago. Valuing NIKOLA based on the earnings is also a challenge, since the company is considered as a startup and still lacks profitability. It's going to require a lot more cash in order to fuel the growth plan. Wall Street believes that NIKOLA will need to invest in $1.1 billion in its business between now and the end of 2025 to stay afloat. As of the first quarter, the company approximately has around $200 million on the balance sheet. NIKOLA also remains a speculative position for the time being. Investors who are considering trading NIKOLA should proceed with caution, as the stock's volatility can present a lot of risks. While the recent rally has been remarkable for sure, it's crucial to assess the company's financials and growth prospects before making any sort of investment decisions. So right now, the global markets are facing a complex interplay of factors that have the potential to significantly influence the equities worldwide. In this speculative analysis, I believe that the consequences of the global inflation, surging commodity prices, and declined quantitative easing, as well as the rise of inflation rates or interest rates, plus the geopolitical instabilities, are going to play a significant part. The increasing inflation rate has been putting pressures across the globe, threatening the purchasing power, raising the input costs, and impacting corporate profitability. Companies operating internationally may face challenges in managing rising production costs and also to sustain profit margins. Those dynamics could trigger market volatility as investors adjust their risk-return expectations. The upward trajectory of commodity prices, including energy, metals, agricultural products, have been having far-reaching implications for various sectors of the global equities market. The companies heavily dependent on these commodities may experience squeezed profit margins, potentially affecting stock valuations and investor sentiment. The reduction or the end of QE's quantitative easing measures by the central banks worldwide may have resulted in reduced market liquidity. So this in turn could lead to higher borrowing costs for companies seeking capital, which may also discourage investment activities or will. The elevated market volatility plus the reduced investors' appetite may also continue to occur. Now, the central banks around the world are tackling this delicate situation of balancing the inflation rates with the economic stability and, if possible, growth. Central banks opted for aggressive interest rate hikes to combat inflations. Borrowing costs for companies have been rising, which has also slowed down business activities and also fueling the market's volatility in terms of the equity prices. Now, ongoing geopolitical tensions, including trade disputes, political uncertainties, and social unrests, will inject an additional element of volatility into the global markets. Investors may adopt a cautious approach, shifting towards safer assets, impacting the equities. Additionally, the escalating conflicts may disrupt supply chains, negatively impacting the performance of international companies. Given the interconnectedness of global markets, the aforementioned factors have reverberating effects on the US equities market. Companies with significant exposure to international market may face a lot of headwinds resulting from the economic slowdowns, disrupting the supply chains and the currency fluctuations. But nevertheless, the US market is known for its resilience, and the diverse sectors may attract investors seeking safe havens. So really, the current landscape is characterized by global inflation, surging commodity prices, reduced quantitative easing, rising central bank inflation rates, geopolitical instabilities, and also ongoing lack of certainty regarding growth. While the US market may exhibit relative strength due to the safe haven status, it's going to remain interconnected with the global economic landscape. For long-term investors, these conditions may offer opportunities to identify undervalued companies with strong fundamentals and international diversification. With that being said, short-term trades should be approached with caution because of the increased volatility and uncertainty. And also, we should be careful when assessing individual companies, sectors, or regions, instead of choosing ETFs. I would recommend to buy NIKOLA shares as a short-term speculation position for the time being, and to potentially buy it for a quick sell in the upcoming month. There may still be a lot of hurdles ahead for the company, and given its history, I believe that it'll take quite a bit more convincing for me to buy NIKOLA as an investment